Most investors spend their lives trying to invent a new strategy. They search for secret formulas, complicated indicators, and systems that promise to beat the market. But one investor built a fortune doing something far simpler. Instead of inventing a strategy, he copied one. The investor we're talking about is Mohnish Pabrai, a man often nicknamed the Indian Warren Buffett. And interestingly, he has never hidden the secret behind his success. In fact, he says it openly. His investment strategy is something he calls shameless cloning. In other words, studying what the best investors in history did and then doing the same thing. But to understand how that idea worked, we have to go back to the beginning of his story. Mohnish Pabrai did not start his career as a professional investor. He was originally an engineer who later built an IT consulting company in the United States. Like many entrepreneurs in the early stages of building a business, his life revolved around solving problems, finding customers, managing teams, and trying to grow the company. Eventually, something unexpected happened. Someone offered to buy a small portion of his business. After everything was finalized after taxes and expenses, Pabrai suddenly found himself with about $1 million in cash. For the first time in his life, he had real capital sitting in a bank account, and that moment created a very simple question. What should he do with it? Instead of jumping into speculation or chasing market trends, Pabrai began studying the greatest investors in history. Two names stood out immediately: Warren Buffett and Charlie Munger. He read their shareholder letters, interviews, and biographies. He studied the philosophy that built one of the most successful investment records in history. And as he studied their methods, something fascinating became clear. The strategies Buffett used were not mysterious. They were not built on complicated financial formulas. In fact, they were remarkably simple. Even more interesting, many of Buffett's ideas looked very similar to the principles entrepreneurs already use when running businesses. That realization became the foundation of Pabrai's entire approach. From that moment forward, he began following a small set of investing principles he had learned directly from studying Warren Buffett. Before we walk through those principles, take a moment to subscribe to the channel and turn on notifications so you don't miss future videos exploring the ideas and strategies behind some of the world's most successful investors. And those principles would guide every investment decision he made. First, think like a business owner. Many people treat stocks like trading chips. They buy and sell quickly, hoping the price will move in their favor. But investors like Buffett and Munger see something completely different when they look at a stock. They see a business. When they invest, they imagine they are buying a portion of an actual company that produces goods or services, hires employees, serves customers, and generates profits. That means the real question is not whether the stock price will rise tomorrow. The real question is whether the underlying business is strong. Does the company produce consistent earnings? Does it have loyal customers? Does it possess some advantage that competitors cannot easily copy? When you begin thinking this way, investing stops looking like speculation and starts looking like business analysis. Pabrai adopted this exact mindset. Instead of predicting market movements, he spent his time studying companies, reading financial statements, and understanding how businesses actually make money. Second, look for what everyone else hates. Markets are emotional places. Investors often chase excitement and ignore anything that appears boring or unpopular, but that emotional behavior creates opportunities. When everyone loves a particular industry, prices can become dangerously expensive. But when everyone avoids a certain industry, prices can fall far below the true value of the underlying businesses. Pabrai learned to search for companies that were ignored, disliked, or misunderstood by the market. During the late 1990s, technology companies were exploding in popularity. Investors were pouring money into internet startups, many of which had no profits and sometimes barely even a working business model. At the same time, traditional industries were being completely ignored. Steel companies, industrial manufacturers, funeral service companies. These businesses were steady, predictable, and profitable, but they were boring. So investors overlooked them. Pabrai did the opposite. He began buying these simple, undervalued businesses while everyone else was chasing technology stocks. When the technology bubble eventually collapsed, many popular internet companies lost enormous value. But the boring businesses Pabrai had purchased continued producing profits. Their value had always been there. The market had simply ignored it. Third, structure investments so that the downside is limited. One of Pabrai's favorite expressions captures this idea perfectly. Heads, I win. Tails, I don't lose much. This means searching for investments where the potential reward is large, but the possible loss is relatively small. For example, Pabrai once invested in a steel company that was trading at only about 3 times its annual earnings. The company also had a large amount of cash on its balance sheet and contracts guaranteeing strong profits for the next couple of years. So even if the business slowed down later, the company's existing earnings and cash reserves would likely cover most of his investment. In other words, the risk of permanent loss was limited. But if the market eventually recognized the company's true value, the upside could be significant. And that is exactly what happened. Another company eventually offered to acquire the business, and the stock price rose sharply. But the real lesson is not the outcome. The real lesson is the way the investment was designed from the beginning, minimizing downside risk while leaving room for large gains. Fourth, practice extraordinary patience. This might be the hardest principle of all. Most people think investing is about constant activity, buying, selling, checking the market every day. But many of the best investors in history built their fortunes by doing very little. Pabrai once joked that someone who enjoys watching paint dry might become a great investor. Because patience is one of the most valuable skills in the investment world. Great opportunities do not appear every day. Sometimes investors must wait months or even years before finding a truly attractive investment. And once they find one, the next challenge is simply allowing time to work. Even Warren Buffett once explained that during decades of investing, only a small number of decisions truly mattered. Hundreds of investments were made, but only a handful produced the majority of the gains. The key was not constant action. The key was patience, discipline, and the willingness to let compounding work over long periods of time. So Pabrai decided to test these principles for himself. He took his $1 million and began investing using the philosophy he had learned from Buffett and Munger. For several years, he invested his personal money while still running his technology company. And the results were remarkable. Within about 5 years, that original $1 million had grown into roughly $13 million. That represented annual returns of about 70% during that period. Eventually, some of his friends began noticing what was happening. They had been hearing about his investments and seeing the results, and they started asking him a simple question: could he invest their money as well? Instead of occasionally sharing stock ideas, they wanted him to manage their investments directly. So in 1999, Pabrai launched his own investment partnership, and once again, he copied Warren Buffett. Buffett's early partnerships had a very unusual structure. There were no management fees. Investors received the first portion of returns. Only after that did Buffett receive a share of the profits. Pabrai used the exact same model. No management fee, only performance-based compensation. And slowly, the partnership began to grow. More investors joined. Assets under management expanded into the hundreds of millions of dollars and eventually approached the billion-dollar range. But perhaps the most interesting part of Pabrai's story is his honesty. He never claims to have invented a revolutionary strategy. Instead, he says something surprisingly simple. If someone has already discovered a method that works extremely well, the smartest move is to study it carefully and apply it. That is the idea behind shameless cloning. And it reminds us of something important. Knowledge compounds just like money. Benjamin Graham influenced Warren Buffett. Warren Buffett influenced Mohnish Pabrai. Each generation studies the ideas of the previous one and builds on them. Just as capital compounds over time, wisdom compounds across generations. And sometimes the most powerful strategy is not inventing something new. Sometimes the smartest move is recognizing what already works and having the discipline to follow it.